Good morning, this is Ken Long from Tortoise Capital Management with a review of the Tortoise Weekend Reports for May 14th, 2011. We have a market that is in bullish normal conditions on an annual basis using weekly RSI 14. It scores at 63, which is slightly above the midpoint. On a short-term basis using the 10-day NDX, the score is 25 for the low end of normal on a short-term basis. The stretch above the 200-day moving average at 9.19% is still bullish, but it's coded white because it's been stronger in the last 180 days. The slope of the 50-day moving average is 0.23%, which is positive, but still rated as bearish and in the red because that's among the weakest scores of the last 180 days. ADX 14 is at 11.5, which is extremely weak and non-trending, or in other words, a sideways trend, and we'll see that on the charts. ATR percentage creeped up a fraction to 1.09% using ATR 14 percentage, and that's right in the middle of normal. Equities were going sideways all week, no directionality. There were some directional days intraday, but nothing that persisted throughout the week. There is a slight advantage accruing to the U.S. and its defensive sectors, which we'll see when we get to the world market model. Some really powerful moves and relative strength in the defensive sectors. Commodities experienced more weakness this week, and silver remains extremely volatile. No change in the rebalancing projects for monthly or quarterly. The monthly rebalancing is due on or about 1 June, and the quarterly rebalancing on or about 1 July. In ETF 2, we're selling Germany and South Korea by rule. Both of them are below average on both AVG and strength ratings and are negative on the 5-week rate of return. The theoretical exposure is at 40% this week, with 4 of the 10 indexes positive on a 5-week rate of return, and therefore with the 2 new sells, the model portfolio will be at 40% also, and so there's no additional buying this week. We're preparing this weekend for the research weekend with a dozen folks, and followed by a live trading week in Kansas City. And you can see the link for asking additional questions or comments that we'll talk about later tonight in the weekly webinar. Looking at the market health check, vertical blue lines are 10, 20, and 30-day lookbacks. The horizontal purple line is the current swing high at about 137. The dotted purple line was the previous swing high at about 134.5. See, the solid black line in the middle is the sloped regression line, the 30-day regression line, and the outer channel of black lines is created by the maximum excursion from that regression line during the look-back period on or about 19 April. You can see price hovering right on the 10-day moving average, and in general the sideways price action of this last week. Long real bodies, large real bodies, so we're having directional days, but there's no persistence from day to day. So getting an early move in the sideways market is allowing us to take advantage of the channeling type of action, but there's little to no advantage in holding overnight. The price and the 10-day moving average are better than the 50, which continues to slope gently upwards, and we're about 9% above the 200-day moving average. You can see the current measurements for 5% and then 10% pullbacks from the current swing high. As long as we're in this top block, we're still within market noise. And once we get past 5%, we can start talking about a normal correction in a bull market. You can see ADX has rolled over and is now just under, right around 12-ish, and both plus DI and minus DI are declining. That's a pure sideways market is what we're seeing right now. Williams percent R, the short-term oscillator, we're approaching oversold conditions here, and on an annual basis we're still in the top 20% of price over the last 12 months, or the last 260 trading days. ETF2, the top 10 regionals, You can see we've got 6 out of the 10 are red over the last 5 weeks, which brings us to a 40%, 60% exposure. We were 60-40 last week. Bull normal conditions. SPY at 64 is better than the rest of the world at 51, using AFA as our measure. Inside the U.S. sectors, the strongest is mid caps, followed by technology, and closely by large caps and SPY, with the small caps lagging somewhat behind. Strongest 2 sectors are mid caps and U.S. tech, and the 2 weakest sectors, ILF and emerging markets. Latin America and emerging markets continue to suffer. Looking at the world market model, the U.S. has moved back to slightly above average now, with only the small cap value lagging somewhat. You can see the weakness in the commodities persists, with oil and silver especially having not yet recovered from their sell-offs. Asia generally lagging, with only Singapore and Taiwan above average. China, Australia, and India continue to be the laggards. Latin American emerging markets all over the place suffering. Canada, Mexico, and Brazil, and the commodity-based economies are suffering. European region lagging. You can see the only green on the board right now are in the U.S. sectors that are defensive in nature, staples, utilities, and healthcare, and that's reflected in strength in the global markets as well. This healthcare includes not only deliverers but also biotech. On a longer-term technical basis, we had a few more sectors move towards cash this week. Generally, the globals, along with basic materials and finance, continues to lag. Looking at the top 30 ETFs in the database, it's dominated by healthcare, biotechs, more healthcare. The retailers are remarkably strong, pharmaceuticals. So you're seeing food and beverage, telecom. Now the U.S. telecom also has a utility component to it as well. And so you're seeing the defensive sectors continuing to lead the way here. And among the shorter term, most liquid and most volatile report here, we have silver and gold remain in positions 5 and 6, with silver being extraordinarily volatile here intraday, with a 7.88% ATR percentage, which makes it an ideal candidate for tactical trading intraday because of its intraday trending characteristics. The VIX at 4.46%, about 50% off from its highest intraday volatility of over a month ago. The remaining symbols that are highlighted here are those that are exceptionally volatile intraday for the shorter term traders. And that concludes the weekend report and review. This is Ken Long from Tortoise Capital. Keep your powder dry.